In 1982, a young hedge fund manager walked onto a national television set and told the world that a financial collapse was coming. He had spent months building his case. He analyzed debt patterns, studied historical precedents, mapped what he believed was an inevitable chain of events. He wasn't guessing. He was certain. Not the cautious, hedge your words kind of certain. The full commitment, stake your name kind of certain. So he did. He went on television and staked everything on that prediction, and then nothing happened. The economy didn't collapse. Markets didn't crater. They surged. Growth accelerated. Stocks climbed. And with every point of that upward move, his certainty transformed into something else entirely. Wreckage. He lost his clients. He lost his staff. He had to dismantle the firm he'd spent years building, and at the lowest point, he called his father and asked to borrow money just to keep his lights on. His name was Ray Dalio, and that humiliation became the most important financial education of his life. Here is the twist most people miss when they hear this story. Dalio didn't spend those months of failure studying where he went wrong in his market prediction. He spent them asking a deeper and more unsettling question. What kind of thinking leads a person to risk everything on a single outcome? What does it feel like to be that certain? And is certainty itself, the very confidence that drives most investors forward, actually the thing that eventually destroys them? Those questions led him to the principle that would define the next 4 decades of his career. And by the end of this video, you'll understand exactly what that principle is and why the investors who live by it consistently end up ahead of those who don't. But before we get there, let me ask you something. Think about the last investment decision you made with real conviction. A stock, a property, a business bet. Something you felt genuinely good about. Now ask yourself, at the moment you made that decision, did you spend more time imagining how it would succeed or more time stress testing how it could fail? Be honest. Because the answer to that question tells you almost everything about where your financial life is likely to go. Most investors spend the majority of their mental energy on the upside. That's natural. That's human. But Dalio, after 1982, became obsessed with the opposite. Now, what he discovered in that obsession was what he eventually called the holy grail of investing. Here's what it is. Imagine you hold 10 different investments. If all of them tend to behave the same way, rising together in good times, falling together when things turn, then you haven't actually diversified anything. You've just created the illusion of diversification. You're holding 10 positions that are essentially one position wearing different clothes. True protection, Dalio realized, comes from something structurally different. It comes from holding assets that are genuinely uncorrelated, assets whose movements are driven by different forces, so that when one drops, another either holds steady or moves in the opposite direction. And when you combine enough of these genuinely distinct bets, he found somewhere around 10 to 15 was the threshold. Your overall risk drops sharply, even if each individual position carries meaningful risk on its own. He ran the numbers repeatedly. The math was consistent. The same expected return with dramatically lower volatility and dramatically lower downside risk, simply by structuring things correctly. He called it the Holy Grail because it appeared to offer something markets aren't supposed to give you for free. Now, I want to stop here for a moment because this is where most explanations get too abstract too fast. So let me give you a real picture of why this actually matters. Think about someone, common David, who built a comfortable career in finance through his 40s. Smart man, well-read. He'd been investing for 20 years and genuinely believed he understood markets. By 2007, he had most of his net worth in a combination of financial stocks and real estate investment trusts. Different assets, he thought. Diversified. When colleagues suggested he was overexposed to a single underlying thesis, that credit would remain cheap and the financial system would stay stable, he politely disagreed. He could point to the names, different sectors, different geographies, Diversified. By the end of 2008, he had lost roughly 60% of his investable wealth. Not because he was careless, not because he hadn't done research, but because the things he held that appeared different were actually all driven by the same underlying force. When that force reversed, everything fell together at once. David's story isn't dramatic or unusual. It's the standard story. Most people who experience catastrophic losses weren't reckless gamblers. They were careful, educated people who confused the appearance of diversification with the reality of it. This is the core insight Dalio built the all-weather portfolio around. He mapped four fundamental economic environments: growth accelerating, growth contracting, inflation rising, inflation falling. Graphic, four-quadrant grid: rising growth, falling growth, rising inflation, falling inflation. Every economic period in modern history fits somewhere in that grid, and he built a portfolio designed to have something genuinely positioned to perform or at minimum hold in each of those four worlds, not as a theoretical exercise, as a structural commitment. The results surprised even him. Across decades of backtesting and real-world application, the portfolio lost relatively little even in catastrophic environments, while still compounding meaningfully in favorable ones. But here's what most observers missed. It was never designed to be the top-performing portfolio in any single year. It was designed to be a portfolio you could actually hold through a full cycle without destroying your financial life in the bad years. And here's where the math becomes deeply personal. If you invest $100 and lose 50%, you now have $50. To return to where you started, you need a 100% gain, not 50%, 100. You have to double what remains just to break even. This asymmetry is one of the most underappreciated forces in personal finance. It quietly follows most investors throughout their entire financial lives, eroding decade after decade of potential growth, while the investors experiencing it rarely see what's happening. One catastrophic year, 1 year where you lose 40 or 50%, can eliminate the compounding gains of the previous 4 or 5 years. You spend the next several years not building, just recovering. And the time you lose in that recovery is the real cost. Not the numbers on the screen, the time. Time is the one thing compounding absolutely requires, and it cannot be replaced. David eventually rebuilt, but it took him 7 years to get back to where he was. 7 years of compounding, gone, not because of a market crash, because of a structural misunderstanding he could have corrected long before the crisis arrived. Dalio put it simply: the most important rule is not to lose money, not as a slogan printed on a poster, as a literal structural priority that shapes every decision you make. Now let's go deeper, because everything we've covered so far is about portfolio mechanics. But the more interesting part of Dalio's framework is what he learned about the psychology underneath the mechanics. And this part affects you regardless of what you invest in or how much you have. After 1982, he developed a belief that your greatest obstacle in investing is never a lack of information. It's almost always the way your own mind distorts your perception at the exact moments when clear thinking matters most. Remember that question from the beginning? Did you spend more time imagining success or stress testing failure? That asymmetry isn't a personal flaw. It's a structural feature of how human psychology interacts with markets. And Dalio spent the rest of his career building systems to fight it. Consider this. In a rising market, prices go up steadily. Your portfolio grows, people around you are doing well. And at that exact moment when optimism feels most justified, the structural risk in the system is typically at its highest. Valuations are stretched. Leverage has accumulated. Everyone is positioned in the same direction. Yet it's the hardest possible time to feel cautious because everything around you is signaling that caution is unnecessary. Now consider the reverse. Markets have fallen sharply. Your portfolio has declined. The news is uniformly bleak. And at that moment, when pulling back feels obviously correct, the structural conditions are often improving. Valuations have reset. Future expected returns are higher than they've been in years, but it's almost impossible to act on that reality when everything around you is screaming danger. The market is exceptionally good at separating you from your money at exactly the moment you feel most confident about keeping it. That's not a cynical observation, it's a mechanical description of how cycles work. Let me tell you about a lawyer. Sharp, disciplined, someone who had managed money carefully for 30 years. Through his 50s, he held a straightforward mix of index funds and bonds. Nothing exciting, but consistent. Then in the final years before his planned retirement, he started hearing about a specific sector from colleagues, clients, people he respected. It seemed compelling, the numbers looked strong. He shifted a meaningful portion of his retirement savings into a concentrated position. The thesis wasn't crazy, but it was wrong. Within 18 months, he had lost nearly half of what he'd moved. Not because he was unintelligent, because the emotional pull of a compelling story combined with the social evidence of watching people he trusted participate overwhelmed the discipline he built over 3 decades. One deviation, one moment of confidence in the wrong environment, and the work of 30 years was partially undone. Dalio designed systems at Bridgewater specifically to interrupt this pattern. Not because he thought he was immune to it, he explicitly believed he wasn't. The systems were built precisely because he knew how powerful the pull was, and that no amount of intelligence or experience made you fully resistant. He called this approach radical open-mindedness, and it meant something very specific in practice. Before any significant commitment, you were required, structurally as part of the formal process, to identify the most credible argument against your own position, not a straw man version of the opposing case. The strongest real argument for being wrong, and then you had to genuinely weight it, not dismiss it as a formality. If you couldn't construct a compelling case against your own thesis, that wasn't confidence. That was a warning. He had a formula he returned to throughout his career. Pain plus reflection equals progress. The pain of being wrong was inevitable. He'd experienced it catastrophically in 1982 and in smaller ways dozens of times afterward. What separated investors who learned from investors who repeated the same errors was what happened in the hours and days after the pain arrived. Did you search for explanations that preserved your original view, or did you genuinely examine whether your fundamental assumption was flawed? Most people, in most circumstances, do the first. The mind produces these justifications automatically and almost immediately. The second path requires deliberate and uncomfortable work, but it's the only path that actually updates the model you use to make future decisions. Comfort is the enemy of improvement, and nowhere is that more consistently true than in how people manage money. Now, let me briefly touch on something Dalio spent years studying that almost nobody in conventional finance takes seriously enough. He called them long-term debt cycles, not the familiar cycles of 5 to 10 years that end in standard recessions. The long ones, the cycles that span 50, 75, or even 100 years. His research showed a consistent pattern across dozens of countries and centuries. Economies accumulate debt, the weight eventually becomes unsustainable, and what follows is an extended period of deleveraging. Not a standard recession, a structural reset where debt is reduced through defaults, austerity, or most commonly, the quiet erosion of currency value through money creation. Every major paper currency in modern history has lost substantial purchasing power across generations. The investors who understood this pattern didn't become pessimists. They became structurally prepared, holding assets that survived or benefited from monetary erosion, productive businesses, real assets, things with genuine scarcity that no government could simply manufacture more of. If you never seriously asked yourself what percentage of your savings is protected against sustained purchasing power erosion, that question is worth sitting with. Let's bring this into something concrete, because principles without application are just interesting conversation. The practical framework Dalio built from all of this came down to a few things he applied consistently. Never concentrate risk beyond what you can survive losing. And recognize that the emotional pressure to concentrate is always highest when concentration appears most justified, when a thesis is working and confidence is elevated. That's when the temptation is greatest and when the caution matters most. Before any significant decision, know the scenario in which you are completely and fundamentally wrong, not partially wrong, structurally wrong. And then ask whether you can absorb that outcome without catastrophic near-term damage. If the answer is no, if being completely wrong ends you, then the position is too large regardless of how strong the thesis appears. And understand deeply the difference between volatility and real risk. This distinction is the one that costs investors the most, and it operates in two opposite directions simultaneously. The first error is selling durable, high-quality assets during temporary market downturns, converting what was volatility into a realized permanent loss. Someone holds a portfolio of genuinely strong businesses through a decade of careful investing. Markets decline sharply during a period of macro fear. They sell at the bottom, lock in the loss, and then watch the recovery happen from the sidelines. The volatility became real damage only because of the decision made in response to it. The second error is holding speculative, fragile positions through sustained declines, mistaking what is actually permanent loss for what they hope is temporary volatility. The thesis was wrong. The position is deteriorating for structural reasons. But the investor holds as to the position and watches what began as recoverable damage become permanent. The market consistently and reliably pushes you toward both these errors simultaneously. It makes quality feel dangerous during downturns and speculation feel safe during rallies. Designing a system that resists both pressures, that tolerates volatility and genuine quality while ruthlessly cutting exposure to structural risk, is where real capital preservation begins. And here's the thought that ties everything together. Dalio returned to one image when explaining why all of this mattered to him beyond the numbers. He saw markets, economies, and individual financial lives as machines, systems with predictable mechanics once you understood how they worked. Not perfectly predictable, but consistent enough in their structure that the people who understood the underlying dynamics would always have an advantage over those simply reacting to surface events. The failure of 1982 was a failure to understand his own machine. He built a model of the world's, treated it as reality, and committed everything to it without seriously stress testing the possibility that the model itself was wrong. What he rebuilt afterward was not a better model. It was a different kind of system, one designed to survive the moments when the model was wrong, because those moments would always come. That is the shift. Not from optimism to pessimism, not from conviction to indecision. From building a system that wins when you're right, to building a system that survives when you're wrong. You will be wrong about something important. Dalio was, publicly, catastrophically, at the worst possible time, professionally. David was, the lawyer was. The question isn't whether it will happen to you. The question is whether the system you've built can absorb it when it does, or whether you'll spend the best years of your compounding window simply getting back to where you started. Everything else is just details. If you've ever held a losing position longer than you should have, or sold a good one in a panic, tell me which one in the comments. Because both mistakes come from the same place, and recognizing which one is yours is the first step to fixing it. And if you know someone right now who is investing with more confidence than caution, share this with them. It might be one of the more genuinely useful things you pass along this year.